Well, hello everyone, and welcome to After the Close. The bell has rung, the trading day is over, and we get to link arms together here for the next 45 minutes and discuss trading when maybe you have a full-time job and you aren't able to be placing trades during the market day, or you're not able to devote a lot of time during the day. I met one guy when he started trading. He had a full-time job, had kids who were in a lot of activities, and his time to sit down and look at the markets was at 8 or 9 o'clock at night. And so if you're in that boat, this is the perfect class for you. Over the last few months, we have been working at building a portfolio together. We're going to review that portfolio, and then I have some news to share with you because there are some changes coming in. But let me get through our important information, and then we'll get into some of that. If you are not following me on X, I invite you to do so. My handle at Barbara Armstrong CS, and we have Mike Fairborn with us in the chat. His handle, Mike Fairborn CS. We're both posting content on a daily basis that we think you'll find informative and helpful. So consider this your invitation. But, we're going to cover a lot of ground today, and our focus today is going to be on looking at sectors that are rotating into favor and seeing if we have those represented in our portfolio, and if not, how can we find stocks in those sectors to perhaps add. So that's going to be kind of our format for today, but know that everything we're looking at is just for general information purposes only, none of it to be construed as a recommendation. When we look at options, know that those carry a high level of risk and are not suitable for all investors. We also use the Paper Money software application on the Thinkorswim desktop platform, and that is a brilliant place to learn, become familiar with the platform, and become familiar with your trading strategies before you consider trading in a live account. When we use stop loss orders, know that those don't guarantee that you're going to get out at a particular price. If something were to gap down, you could end up stopped out at a lower price than you were expecting. Okay, so I have a few things that I want to share just before we get into the thick of it. And I want to thank all of you that are here. I see a lot of the usual suspects, including Josh Pink, who I've met live and in color, at an event in Anaheim last weekend, actually. So it's great to see him back in the saddle so quickly after being in Anaheim at the Advanced Options event. And to John the Noble Savage, who is often sharing quotes in the chat, which you don't get to see if you're watching this in the archives. The chats aren't available. But to Jack and BJ and Andrew, and I'd Never Eat Here, and Kevin and the rest of the gang, it's great to have you all here. So here are some of the changes that are coming. I have been away a lot this year on Thursdays, as it would turn out. And so I probably only got to teach this class about half the time. So I am going to pass the baton over to Kevin Horner starting next week. And Kevin Horner will be teaching this class starting next Thursday. And he may take it in a little different direction. You'll have to wait and see, what ideas Kevin has up his sleeve, but he's a great guy and an awesome coach. And I think you'll be in really good hands. And it's a great time for me to be passing this baton over because, as luck would have it, this is the only a Thursday that I will, be in town in the month of June. So I would have had somebody filling in for me. So it's great to have Kevin starting where he will have more continuity with it. And so this will be my last time teaching this particular class. Now, I do teach every day. So on Mondays and Fridays, I've still got Trading a Smaller Account, Getting Started with Technical Analysis on Tuesdays, and Trading Price Patterns on Wednesdays. So that's going to continue to be the same. Now, I mentioned going to a live event and the fact that Josh was there, and I know that many of you may have considered going to an in-person event. I got introduced to the world of investing actually at a live event, and I lived in Michigan at the time, but I would drive to Cincinnati or Chicago, or I'd get on a plane and fly to a conference in Florida, or I went to a workshop in DC, and I actually ended up with a job when I came here to Salt Lake City to attend a trading event. So, I love in-person events, and I think, and Josh, feel free to chip in, with your perspective on this. But we just did a 2-day advanced options workshop. Ben Watson led the charge. We had Kevin Hinks from the network teaming up with Ben, and then Joe Mazzola, who's a frequent contributor on the network, writes a lot that you'll see, information that you can see the inside edition, kind of what's happening in the markets. And he's also a senior manager at Schwab. So Joe spent a lot of time on the stage, and they shared both what has worked for them historically and perhaps even more importantly, what hasn't worked. We have 2 market drives coming up. Kevin Horner will be at the one in Miami next weekend. I'll be at the one in New York at the end of June. And then we've got another, 2-day workshop coming up in Santa Clara in July. The first day is technical analysis, second day options, and these are all free to attend. And if you have never been, I'd highly encourage you to check these out. Even though they're free to attend, they tend to book up quickly. So please, please, please register sooner rather than later. And for these market drives, we provide breakfast and lunch, and then an awesome reception with fantastic hors d'oeuvres and, an open bar at the end of the day. And they're really a chance to connect. And one of the things I love seeing in Anaheim at lunch, there were people sitting outside at these big tables and animatedly sharing kind of what they learn or what they're doing in their approach. And, it's a really great community. So if you've never attended a live event, you may want to check them out. So, and we're going to be in Chicago, in DC, in Dallas, in Orlando. We are all over the country. We're doing 20 some events back in California in November. And then we round out the year in Houston. Funny that we don't end up in Houston, right? In July, when the humidex is at 100, and so is the temperature. Yeah. So we're trying to be strategic there. Yeah. All righty. So that's the live events. So if you've never been, and then if there's anyone that's here for the very first time, if you come to live webcasts and virtual workshops, and you can see, what is being taught every single day. And if there's one coach you particularly love, like let's say you're a big fan of Mike Fairborn, you can come down here and key in Mike Fairborn, and then you can see all the classes that he teaches. And you can see here that starting next week, if you're a ThinkScript fan, that class is going from Fridays to Thursdays, which I'm sure Mike will appreciate also. Yeah. So, and if there's a particular topic you like, you can, type that in also. Webcast series, trading a smaller account. You may have heard of it. And if you just want to see when it's taught, here you go. Okay. So that's that. That's, kind of my news coming up. And yeah. So let's get out to the platform now and look at what's going on, first of all, in the market. And I don't tend to spend a lot of time on this in individual classes now because Kevin Horner chairs a class at the Market Open, I think 4 mornings a week, where they're looking in detail at what's happening on the indexes and with gold and with silver and right down to individual stocks sometimes. But, we have come a long way back from this 20-some% pullback, and over 70% of the way back. Today we're pulling back, there's a lot of press going on today. And, whenever Elon and Trump get into it, the market tends to, react, and it's reacting today. And if we see, and I'm not saying that's the only reason why, but, I was listening to a financial radio station this morning, and there was an awful lot of talk about that as I was coming back. And we can see Tesla, really taking it on the chin today, down 14%. So, that's just kind of an overview. the NASDAQ and the S&P have come a long way back. When we look at the volatility index, it's up a bit today, but this is a 1-year chart. We're kind of back in this range where we have typically been with respect to the volatility or the fear index after, spending, a month and a half or so kind of in the nosebleed section. That started at the beginning of April 1st to be exact, and didn't cross back down below that line until almost the middle of May. Okay, so that's where we are on the index. Now, one thing that, we may want to have a look at, because we were talking about the importance of sector rotation, and that if you're trying to set up a portfolio, and we started with $1 million at the beginning of the year, and we said, in one of our sessions, like, just because we have 11 sectors doesn't mean we want to have an equal weighting in every single sector. In fact, if we look at the S&P 500, it is not equally weighted, is it? Like, if we look at the tech sector, here's our tech sector. And this S&P 500, it's showing 500 stocks. But how is it organized? Well, it's organized by sector. And so here is the technology sector. Like, that is huge, my friends. As compared to the utility sector, here's the utility sector. So if, the tech sector is crushing it, that's going to have a pretty big impact on the overall market. Either up or down. And we can see Palantir is getting hit today. So the darker the color, so if this is really dark red, we can see that this and is it SMCI? These two are the hardest hit stocks in the tech sector. And Micron is having the best day of the bunch. Tesla getting pretty hard hit, but then we have some stocks within the consumer discretionary sector that, are strong today. Amazon, the biggest stock in that sector. And then when we come to the communications sector, Meta's, the biggest, heaviest hitter. Although we do have the two Googs, Goog and Google, and then Netflix and T-Mobile. And then here's our financial sector. It's pretty big too. Not as big as technology, though. None of them are. And then healthcare, industrials. And you can see some of these, like the tech companies all tend to be fairly sizable, or the majority of them look at, as opposed to industrials, where we have GE and Deere that are fairly big, and RTX and CAT. But we have a lot of smaller companies in the mix too, and the same with, smaller being a relative term compared to, materials, real estate, and then here's energy, and last but not least, our consumer staples. So, which sectors have been strongest? And when we started building our portfolio, we were focused on adding stocks in sectors that were really rotating into strength. And so if we look at this, over the last 3 months, industrials have been the strongest sector, followed by technology, utilities, and communication services. Now, if we look at the last month, we can see that utilities is second to last place. So there seems to be, a rotation kind of out of utilities. And we've got consumer discretionary, communications, industrials, and technology. So 3 of those 4 sectors, have been leading the pack in both the last month and in the last 3 months. So communications, technology, and industrials. So if we come to our monitor tab and we look at what we're invested in, technology by far the biggest sector, but we have only 2 stocks, Palantir, which really got hit today. We were up until today. So we're down by, we now are down by $328, after a $3,626 hit today. to the Palantir position. And we can go out and look at the chart, but we have a position on Palantir and one on Cognizant Technologies, where we're up just a little on that one. And I think that one was recently added to the portfolio. So we don't have a lot in technology, and we only have one stock in the discretionary sector, which is McDonald's, which we had done a buy right on. And then in the industrial sector, we've got Deere and Triple M. And so, when we look at, where we've been really strong, it's been communications. And these were some of the first positions that we added. So we have a position in Meta. We have a position in Verizon in this example account, in AT&T. And so if we kind of look at this, where might we want to focus? We have a couple of staple stocks. In fact, we have 4 in that category. And so if we say, well, we only have 2 tech stocks and we only have 1 in the discretionary sector, maybe we want to come out and look at some discretionary stocks. And so you could just bring up a list of all discretionary stocks. So you could bring up a list of all the discretionary stocks. But what might be handy is to say, let's just start by looking at stocks that are in the S&P 500. And also, if you come down here to by industry, say also part of the consumer discretionary sector. And there are 50 stocks that are part of the S&P that are in the consumer discretionary sector. And we can run that scan, and then we can come up to the second set of triple lines, or some people call it, it looks like a hamburger, say that we want to save that scan, and let's call it, this was consumer discretionary. And so now we have a list, and when you come and we bring up a watch list, and let's bring up this one. So we're going to come to our personal, and you'll see this little purple bullet, or it looks to me like a dartboard. But when we pull this up and we see this consumer discretionary, what this means is it's going to run the search when we pick it. And that way, if some consumer discretionary stocks have been added to or taken out of the S&P 500, this will give you the most current list. Okay. Somebody's asking if I can explain the cash and sweep. What this means is I have $363,000 that's sitting in cash that I'm able to invest. So that tells us that we have, $637,000 invested. And if you have sold a put, for example, which means you're willing to buy the stock at that price, and let's say that put is at $50, well, then they would set aside $5,000 in case that stock is put to you. And so that wouldn't be a part of the cash available for you to spend or to invest. Okay. Does that make sense? Okay. So what I did here is I linked my chart by making this a 1 and by making my chart a 1. And I just started clicking through, looking for stocks. And, we saw a lot of, when the S&P in total pulled down by over 20%, you can expect that a lot of the stocks in the S&P had to go down by at least that much, maybe more, in order to have this whole index come down this much. So it's not surprising to see that Amazon got pulled down, but then like so many other stocks, I was saying for weeks that, diagonal, we would call this a diagonal resistance breakout, because this seemed to be acting as a ceiling, and it broke out, and then it hit earnings and ended up gapping up and it seems to be back on its way. Now, I have been looking for a few items that aren't commonly found in regular retail stores. And when I've asked friends who purchased those items in the last couple of years where they went, almost every single person said Amazon. It just seems to be where a lot of people kind of often will look first for something. And although I was a late adapter on the Amazon front, when we look at this, year to date, this stock is still down. It's down 6% over where it started at the beginning of the year. But this is a company that's pretty well established, and some might argue, they expect to be around for some time. And so as it's beginning to kind of get its feet back under it, might this be a stock that you want to consider adding to your portfolio? And you can come to the Analyze tab, and there's lots of places to get this information. So you might say, well, what do the analysts think of this? And so we have a bunch of analysts here who all have an opinion. You could click and download those reports and have a look at them. You can also bring up live news on this is called the gadget section. And you can just kind of scroll through. So, we recently had an earnings announcement on this. So if we come down and we look at this, JP Morgan adjusted their price target to 240 from 225. New Street adjusted their price target to 260 from 258. Well, that's not a really big change. JP Morgan to 240, 260, and you can just kind of scroll down. Amazon, B of A raised their price target from 248 to 230. Loop Capital adjusted their price to 290. So we have price targets here from 248 to 290, and who's right? Well, who knows? But some of what we may be looking for, and you can then click on each of these, and there may or may not be more detail underneath, but it's currently trading at 218. And if those prices range from 238 to 290, that's a pretty big range. But one thing that it seemed was consistent was that they were all raising their price targets, not lowering them. And the other thing that you may want to consider is coming to the Analyze tab and then scrolling down. Now, if you didn't know what this company does, you can, read through here. They offer Amazon Prime. They're producing content now. They started as a book company, which is interesting, right? Selling books. And now they sell a little bit of everything. And then you could come and look at their sales per share have been increasing year over year for the last 5 years. Well, does that mean they're going to continue to increase? Not necessarily. Their earnings per share moved up 47% from 2023 to 2024. Does that mean that it's going to continue to go up? No. And in fact, you can see here from 2021 to 2022, they took a big hit. So there it is in spades that their past performance doesn't guarantee future success. But if we look at their price earnings ratio, and Mike Fairborn is really good on the fundamentals, their 5-year average on this has been $92, which means you would have to invest $92.86 to get $1 of profit. Well, their current PE ratio is 30.99, which is saying hey, it's a deal from that perspective compared to what their price earnings ratio has been on average over the last 5 years, which is just another interesting piece of information. And then when we team that up with the charts and say, well, it's come up off its low by how much? 29%. So some might say, well, have I missed it? But the idea is you want to catch something in motion and have it continue in motion. and then know that there is a possibility that, this uptrend might not go forever, as we saw here. It went from 151 to 242 and then came back all the way down, well, to 162, to within $10 of this 1-year low. And so this is where, there's an example trading plan in the Trader Talks on YouTube. And if you haven't subscribed to the channel, you'll want to do that. And I'll show you where that trading plan is. But this idea of an example trading plan where when you get in, the way you manage it. So had we bought this, just let me erase this. Let's say we had looked at it, it got a little beat up here, and we were waiting for it to cross back above this 30-day moving average. So let's say we bought it here. So let's say we bought it here, or you may have bought it here if you were being, more aggressive, thinking, it's come back up. So let's say we bought it around this 175 level. And then it came down to the 30-day moving average, and we were going to put our first stop would have been below this recent low. And then it came up and came down and closed below the 30-day moving average here. So we would have moved our stop up from here to here. And then it came up and closed below the 30-day moving average. So we would have moved our stop up to below here. And then it came up nicely, came back down, didn't close quite below, but it kissed it. So to err on the side of caution, you may have said, okay, I'm going to move my stop up to here. Okay. And when we first got in, I was saying if we picked, like, let's say this date here, we were in around this 175 mark. So now our stop is closer to this kind of, 190-ish level. And then it comes up and it closes below this again. So now we move the stop up to here. So maybe now our stop is around 215. And what we're doing here, we know that it could gap down, but we're trying to protect some of our gains. And then it comes up again and comes down and closes below this 30-day moving average again. So we move our stop up here. And here we would have been stopped out. And then if your rule says, well, I get back in when it crosses back above the 30-day moving average. So when would we have gotten back in? Well, it came here, it was flirting with it, came back, flirted with it again. So let's say we got back in here. So we would have got in at 175. We would have got out around, I can look up exactly what that number would have been, but let's say we got out at 225. So that's about a $50 a share gain. That's not too shabby. And then when would we have entered again? Let's say here, it was trading maybe 180. I'd have to look at that candle in particular, around 188. And it's now at 207. Well, we didn't get back in at 188, but it gapped up, came down, and is moving again to the upside. So we are where we are now. But this is the idea of how this plan might work. And so if we get in now, where might we want to put a stop? Because the 30-day moving average, it hasn't quite caught up with it yet. You might say, well, I'm going to look at this recent low, and I'm going to put my stop below that. And so you're giving it enough room to move, but you're protecting yourself from this type of dramatic pullback. Chi is asking, would you say the drop from 240 to 165 was a black swan event? You could call it that. I don't know technically how you define a black swan event, but there were a lot of crows flying around. I don't know about black swans during this time when so many things on the market were getting hammered. Okay, so does anybody have any questions about this idea for a trading plan? And I mean, ideally, you kind of want to get in here when it's just crossing that 30-day moving average. So if we put this in here, and let's say it does continue to go up, we'd adjust our stop when it comes back to a support level. Okay. Okay. So let's place a trade here, and I can't hover and get specific numbers, but if we said we had a stop here when this closed below the 30-day moving average, if you saw it on that day, 228.16 was the price it closed at. And if your rule was you move your stop up to 3% below, you would have been out around 221. And then we said if you had gotten in back when it crossed that 30-day moving average, we were in at about like 185. So that would have been a nice return. And then here, when it first crossed, you may have been a little skeptical. We had this diagonal resistance breakout and then the 30-day moving average, and then it came back and retested. So if you got in on this day, that would have been somewhere between 185 and 188. So we're going to look at, here's our recent low, 197.85. And we're going to go 3% below that times 0.97. So our stop is going to be at 191.91. And so how much are we risking? Well, we're risking, if we subtract that from the current close price of 207.91, we're risking $16 a share. And if we said we're willing to risk like half of 1% of our account and we could risk 5,000, we take 5,000 divided by the $16 a share we're risking, and that's saying we could buy up to 300 shares. Now, we also, our position sizing rule was we have $1 million account, but we don't want any one position to be more than 5% of the account value. So that would be $50,000. So if we said, okay, 50,000, and if I divide that by that call it 208, our current price, that's saying we can't buy 300 shares. We can only buy 240. And so you might say, well, I'm just going to buy 200 because I want to have the ability to be able to maybe sell a covered call or buy a protective put when the next earnings season comes up. So we're going to put in an order for 200 shares. And we're just going to buy the stock. But we're going to buy custom with a stop limit order. We're going to put in an order for 200 shares. We're going to put our stop at 191.91. That's interesting that it came out to 91. 191.91. And we're going to make that good till cancel, confirm and send. And we're going to put this in with our growth stocks. And so that is Amazon. Now let's look, and again, I was just clicking through all the stocks listed in this consumer discretionary sector. Here's Carnival. In Carnival, we had, again, this diagonal resistance breakout that we saw pretty commonly, with many, many stocks that are part of not only this index, but the NASDAQ as well. And then it crossed the river, came back and tested the ice, and then it continued on. And so, if we missed this entry, which we did, might we look at it and say, well, hey, here was a potential ceiling and it blew right past it. It blew right past that ceiling. And so now, here's another potential resistance level is this previous high at 28.72. But it's been moving again to the upside. So it broke through that resistance level, came back to retest, which is not uncommon, and is now moving to the upside again. And if you wanted to do something as an income generating strategy and say, well, I know a lot of people like cruising. I don't know if I want to invest in this as a long-term investment. but I'd like to take my kids to Disney when I do the next advanced options workshop in Anaheim next year, or the grandkids. And I wouldn't mind creating a little vacation fund. So you might say, well, I'm going to put in a target on this at $28. Okay. So we're going to come here, have a target at around $28. We'll just make it 28. So it's a little shy of the previous target. And where might we put a stop? Well, we might kind of go to this old resistance level, and some might not want to do that. And that's totally legit too. You might say, hey, it just recently, we had a stop, it came back here. I want to put my stop below there. And that would be pretty reasonable too. This gives it more latitude. And when you have a stock as opposed to an option, you have time on your side, so to speak. And this thing pays a dividend of 8.3% also, which is certainly not nothing. That's pretty high. So if we look at that as dividends go, now keep in mind, just because it pays a dividend now, and these scripts aren't always spot on, but this one has a PE ratio under 20. Which, some might find attractive, pays a dividend of 8.3%. And so we're going to come to our trade tab now. Position sizing, remember, 50,000. And if I divide that by, call it 23, we can buy 2,000 shares. So if we say, okay, I'm okay to buy 2,000 shares of CCL. And again, we just picking kind of a round number. And then how much are we risking? Well, if we put our stop at 2154 times 0.97, that's at 2089. So how much are we risking? Well, we're risking a couple of dollars a share. So current price is 24. And then I'm going to subtract 2089. So we're risking $3 a share. And if we're saying, well, we don't want to risk more than 5,000, I'm going to divide that by the 311 that we're risking. So it's saying, yeah, you can't buy 2,000 shares. You can buy 1,600. And meet both your position sizing limitation, which is self-imposed, and the amount of risk you're willing to take. And if the stock continues to move up as we're expecting it to do, can we move our stop up from here to here? And then if it comes up and pulls back again and moves up, and then move it up to here? Absolutely. You don't necessarily have to wait when you're doing this as a shorter term income generating strategy for it to cross below the 30-day moving average for you to move your stop up. Like on Meta, for example, we had done a short term trade, and we had a target which at the time was maybe around here, and it came up and we got this kind of candle pattern. And we said, you know what, if it goes more than 1%, or I forget what the number was, below today's candle, we want to take our money, because we were doing it as a short-term trade. And so that's what we did. So, when you trade a stock for different reasons, you can, employ a different trading plan to manage it once you're in the trade. And so we are going to right click on this. We are looking to buy custom with an OCO bracket. So we're putting in both a target, and our target was $28, and a stop, which is at 2089. So our target is 28. And you say, well, that's only $4 a share. Well, this is a $24 stock. So, if you say, well, if I could make $3.96 a share on a $24 investment, that's a 16% return, my friends. That's not nothing. And 2089 is our stop, our initial stop. And how many shares do we want this to be? We're going to make it 1,600. 1,600. And then when I click this little firecracker and turn it into a paper clip, and then click anywhere on these lines, it will make all of these numbers match. And so when we come to confirm and send, we're buying 1,600 shares of Carnival. We want to sell if it goes up by $3.96 a share, or if it comes down by $3.15 or more, it would trigger an order to sell. And again, no guarantee that we're going to get out at exactly the price recommended. And this is known as a swing target when we're trading something back to the previous high. And, you know, so if you have 1,600 shares and you could be up by $3.96 a share, 1,600 times 396, that's 6,336 shares. So I don't know how many kids or grandkids you might have, but that's enough to get that fund started at least, isn't it? If it were to work out. Now you could end up losing money on it too. So, you know, and then so these are teed up for tomorrow. And the one thing you'd want to do is just check when the market opens and make sure that, you know, your position actually gets filled. And if you wanted to look at a couple of other stocks in this sector, CMG just recently had a 50 for one split. It was a very expensive stock. So your, you know, one share became 50 shares. Yeah, and it's now trading at 52.37. And we saw that this came down. And you know, I look at this and it's not textbook perfect, but I see a bit of an inverted head and shoulders. Do you see it? It's sloppy, but it's kind of breaking above, isn't it? You know, and this is a stock that's been beaten up this year. So, but so far this week, having a good week. June's been good to it so far. So that's Chipotle. It's, you know, one that if you wanted to place an example trade, you might want to, you know, look at that, or O'Reilly to go, you know, to auto parts. Now, this one hasn't been beaten up so much, has it? It's just like continued walking up that hill, and it's had some short-term pullbacks, but the overall 30-day moving average has been uptrending. Same with the 200-day moving average. Easy peasy lemon squeezy. It's about to do a 15 for one stock split, which would make it much more affordable. So like if we could have a $50,000 position, that's not very many shares, is it? 50,000 divided by 1371. We could buy 36 shares, but that 36, you know, when I multiply it by 15, would become 547 after the split. So anyway, guys, it has been a pleasure teaching this class. It's been a pleasure hanging with all of you. There is a survey in the chat. So if you click on that link, I'll not only read every comment myself, but I'll pass them on to Kevin, who's going to be stepping in and teaching this starting next Thursday. And it goes from 1, which was I hated it, to 10, I loved it, and I'm going to keep coming back. And you know, everything in between. And my promise to you is if you fill it out, I'll read all the comments. If you'd hit that like button, it helps move things up in the algorithms. Subscribe to the channel if you haven't done that already. And please follow Mike Fairborn and I in the land of X. We'd love to see you there. Take care, everyone. Bye for now.